Welcome to this explainer. Okay, today we're tackling a fundamental and honestly often pretty painful reality of running a business. What exactly happens when customers simply don't pay? We're going to explore how accountants handle this harsh truth, moving from the exact moment a debt goes bad all the way to the incredibly smart, predictive accounting techniques used to protect a business's bottom line. So, here's our game plan for today. We'll start with what happens when customers don't pay, then move into recording irrecoverable debts, the surprise debt recovery, credit control strategies, provisioning for doubtful debts, and finally, adjusting that provision. Let's get right to it.
Section 1. When customers don't pay. Let's look at the reality of bad debts.
Look, to attract and keep customers, you usually have to sell on credit, right? You provide the goods or services now and just trust that the payment is coming later. But despite your absolute best efforts, sometimes that money literally never arrives. The debtor might move away, maybe they sadly pass away, or they just plain run out of cash. When a debt is simply never, ever going to be paid, it officially becomes an irrecoverable debt, or, as it's more commonly known, a bad debt.
And that right there is the ultimate danger of doing business on credit. An irrecoverable debt isn't just some minor annoyance. It's a very real, very normal business expense that essentially leaves you holding an empty bag. You've given away your hard-earned inventory or your valuable time, and you have absolutely nothing to show for it in return.
Moving right along to Section 2, recording irrecoverable debts. This is where we get into the ledgers and journals.
So let's consider how we actually handle a specific customer in the ledgers. Take Penny, for example. Let's say she stopped trading and owes the business $700. We can't just cross our fingers and pretend the debt doesn't exist, right? We have to clear her account. So we make a journal entry. We debit the irrecoverable debts account for $700, which recognizes the expense, and we credit Penny's account for that same $700. Boom. That credit effectively closes her account out, and the debt is officially written off.
Now, the absolutely crucial takeaway here is that this isn't just some basic bookkeeping chore to tidy up a customer file. No way. That debit we just created translates directly into a business expense. At the end of the financial year, the total balance of all your irrecoverable debts gets transferred straight to the income statement, meaning every single unpaid invoice directly eats into your hard-earned profit for the year.
But hey, what happens if a customer can only pay a fraction of what they owe? Imagine a guy named Ian. Ian owes $840, but he can only scrape together $168 in full settlement before he has to close his doors. Well, we don't write off the whole $840. Instead, we just split the transaction. We debit our bank account for the $168 we actually got, and we debit the irrecoverable debts account for the unpaid portion, that remaining $672. Finally, we credit Ian's account for the full $840 to close it all out. Basically, you salvage what you can and you expense the rest.
Okay, Section 3, the surprise debt recovery. What happens when bad debts are actually paid?
Now remember, writing off a debt is ultimately based on a judgment call. And you know what? Sometimes that judgment turns out to be flat out wrong. Imagine a customer, Shanti, who owed Hassan's shoes $500. Hassan wrote it off as an irrecoverable debt. But twist, months later, Shanti unexpectedly walks right back into the shoe shop and hands over $500 in cold, hard cash to clear her conscience and her account. It happens.
To process this awesome surprise recovery, we don't just shove the cash in the till and call it a day. We have to follow a precise two-step method. First up, we reinstate the debt. We debit the debtor's account to show they owe us again, and credit an irrecoverable debts recovered account. Second, we record the actual payment, debiting our cash or bank and crediting the debtor's account to close it right back down. So why jump through these hoops? Well, it maintains a crystal clear historical record in the debtor's account. If Shanti comes back asking for credit later, Hassan's Shoes has a perfect paper trail showing she did eventually honor her debt.
All right, Section 4, credit control strategies. Let's talk about preventing bad debts in the first place.
Look, offering credit is pretty much essential to stay competitive, so you can't exactly just stop offering it entirely. Instead, businesses really need to implement practical credit control strategies. What does that look like? It means asking for trade references or paying for credit checks before taking on brand new clients. It means setting low initial credit limits until a bit of trust is built up. You definitely want clear terms and conditions, maybe even threaten to charge interest on late payments, which, let's be honest, is a fantastic motivator. Or on the flip side, offer discounts for paying early. And crucially, if someone is actively dodging payments, you have to immediately halt any further credit to keep that debt from ballooning out of control.
Moving into Section 5, Provisioning for Doubtful Debts. This is all about anticipating those losses.
Now, we really need to distinguish between a known bad debt and a doubtful debt. An irrecoverable debt, that money is gone forever. A doubtful debt, however, is merely an estimate. Following the accounting principle of prudence, a business shouldn't overstate its profits or its assets. If you've got $100,000 sitting in receivables right now, realistically, someone in there is going to flake and not pay. A provision for doubtful debts is simply how we estimate that future loss today.
So how do accountants actually arrive at this estimated provision amount? Well, they've got a few tools in their belt. They can use past experience, like, say, historically, 2% of all credit sales go bad. They can painstakingly look at each open invoice one by one to assess the risk. Or they can use an aging schedule. This is a super realistic method where the older a debt gets, the higher the risk percentage assigned to it. Because let's face it, a 90-day overdue invoice is way less likely to be paid than a 10-day overdue one.
This perfectly illustrates the matching principle in action. Let's say we have $14,000 in trade receivables and we decide to create a 1% provision. That equals $140. We debit our income statement as an expense for $140, matching the anticipated loss to the exact year the sale was actually made. Simultaneously, on our statement of financial position, we subtract that $140 provision from our total receivables. This safely lowers the reported asset value to a highly realistic $13,860.
Which brings us to our final section, Section 6, Adjusting the Provision, Managing those year-over-year changes. Okay, let's dive into an adjustment scenario. Imagine a business owner. Let's call her Lena. She's decided to consistently maintain a provision for doubtful debts at exactly 10% of her trade receivables at the end of every single year. As her total receivables naturally go up or down, that 10% target amount is going to change right along with it. It is absolutely vital to understand the dynamic of this adjustment. If your trade receivables grow from one year to the next, your provision must increase to match. The difference between the old provision and the new provision gets added to your expenses, which, takes a hit on your profits. But, and here's the really fun part, if your receivables go down, you must decrease the provision. And that difference, it's actually added back to your gross profit, giving your bottom line a very nice little boost. Let's see how this plays out in the books for another business owner, Jose. In 2018, Jose had $3,000 in receivables. His 5% provision was $150. But in 2019, his receivables dropped to $2,000. Now his 5% provision only needs to be $100. Because his required provision decreased from $150 to $100, the $50 difference is just no longer needed to cover potential losses. So that $50 becomes a nice little bump directly back into his income statement, actually increasing his gross profit.
Which brings us to the end of our explainer with a bit of a provocative thought for you. Next time you look at your own financial statements and you see a massive number sitting in your trade receivables, I know it's super tempting to mentally spend it. But I challenge you to view those outstanding invoices through the cautious, highly realistic lens of the prudence principle. Are they guaranteed cash in the bank, or is a portion of them just waiting to become a doubtful debt? Managing credit wisely isn't just about recording history, it's about anticipating the future. Thank you so much for joining me on this deep dive into irrecoverable and doubtful debts. Catch you next time.